All right, welcome, folks. Jeff Ervick here from Valor's Capital Partners. We've got a handful of people coming in to the webinar, so we're just going to give it a few minutes before we get things started. So, hope people are doing all right. Well, the good news is the government's back open, right? So,
Good news.
yep. So that helps me out, right? We got a lot of my customers are open back in office and so forth, so it's nice, but long time waiting for that to kick back open. So very excited there.
Yeah.
All right, we got a handful of folks coming in right now. So again, we'll give it a few more minutes before we get things kicked off. But we do have this recording, so once we start, anybody who misses will be able to come back and watch it anyway. And then, folks, there's actually a Q&A section, and there's also a chat as well too. So, if everybody or anybody has any questions, you can pop it in either the Q&A or the chat. A question actually put in the chat. If you just want to say hi, pop it in the Q&A. But if you want to maybe shout out where you guys are calling from, that'd be great. I'm here in Maryland. All right, Blake, Blake, you guys are in Philly? No, where are you guys from?
I live in Michigan
Michigan, that's
currently.
right.
Yep.
And I'm in Utah.
Okay, Michigan and Utah, and then we got Milwaukee. We got Joseph from Milwaukee, so not too far away from you guys.
Basically neighbors.
Basically
Yeah.
neighbors. Well, from if I
Just
look at
across
it
the
from neighbors
lake.
being I'm from the East Coast, yeah,
Yeah.
basically. You guys are it's right down the road, right? Yeah, just an hour away. I've got in Austin,
Yeah.
Texas. Nice, welcome. EX from Austin. Perfect. Oh, we got Fort Lauderdale. Hi, Janice. How are you doing? Lots of good folks. We got Kevin. I know I've seen that name before. Hey, Kevin. Kevin's from the Maryland area. He didn't say anything, but I know he's from there. All right, we're gonna give it another minute here, and then we're gonna get things started. We had over 50 or so people register, so I know people are walking in or coming in here soon. I guess I get it that it's during the workday, but this is it's noon on the West Coast and 3 here on the East Coast here. Um, so we're gonna get here started in just a few seconds. And I do feel like we've got the Michigan weather came our way, Utah weather. You guys are, getting snow probably already. And I feel like, even though I'm not getting snow, it's definitely freezing out this way.
It's actually pretty nice right here.
Is it? Oh man.
Yeah, we're hitting 60. So, I mean, for here, for Fort
Yeah, it's
Lauderdale, if
pretty
they're
good.
hitting 60, they're like, wearing winter coats. But
Yeah. Especially Fort Lauderdale, right, Janice? Janice has
yeah,
that. Yeah. It was 30s back there earlier this week too. Yeah, for sure. All right. Well, I'm gonna go ahead and kick it off. As people kind of filter in, they'll catch up, but we'll also send this out the recording. So, folks, thank you so much for joining us today. My name is Jeff Ervick with Valor's Capital Partners, and this is the investment optimizer, right? This is how smart investors earn in two different places, right? So we're going to kind of go through everything that we've talked about. And if you followed me on LinkedIn, I talk a lot about how to use whole life insurance policies for arbitrage or for investing and making more money so you can make money in the and protect yourself in a life insurance policy, and then also use that to invest and make money in two different spots, right? So just a quick disclosure, this is for educational and informational purposes only, not, and it's intended for accredited investors or high income professionals seeking to enhance wealth strategies. Not an offer to buy, sell a security, and nor considered legal, accounting, or investment advice. Its participation is limited to qualified individuals who understand and bear the associations of private investments. Again, this is not an investment, so I wanted to make that also disclosure that this is a way to protect your family and build generational wealth, and also use that capital if you've got opportunities for it as well too. So it's um, a lot of different ways to use a whole life insurance policy. And so we'll kind of get into that pretty detail. I'll let Rod and Blake really kind of start diving into there. But what are you going to learn today? We're going to learn what is the investment optimizer and how does it work? Why our partners love it, and why it's valuable and how it actually works in the long run too, because this is not just, again, this is not just I wouldn't even call this an investment strategy, right? This is an optimization for your investment strategy for the future, right? But it is a way to protect you and your family if something happens to you, and also grow your wealth and grow your generational wealth is why I love it. I love it because it helps protect my family from if something happens for me in the future, but also allows me to utilize that capital to go and invest into another deal, right? So we'll talk about the real numbers, the arbitrage advantage, and then what are the key benefits overview, and then who is this for? Who are the people that typically use this kind of strategy for their portfolio? Just a quick thing about Valorous Capital Partners. We're a multifamily investment firm. We have over 220 million assets under management. It's an older picture of me, all right, but it was a picture of me and my partner Claudio. We have over 1,800 units of multifamily in development and under management, as well as we deployed over 50 million of equity into all those opportunities. If you want to read a little blurb about myself and Claudio, there it is right there. If not, we're going to kind of get to the meat and potatoes of it. So I'm going to introduce Rod and Blake from Money Insights. Money Insights is a leading alternative wealth building firm that helps high income earners move from strong cash flow to lasting net worth through the investment optimizer, right? So they've done this over all 50 states. They have 150 plus 5-star Google reviews. These guys are the experts when it comes down to utilizing life insurance for your investments and how to make it rain on that side. So I'm going to go ahead and pass it over to Blake and Rod. If you guys want to go ahead and share, I'll stop sharing my screen.
All right, let's get my screen up here and we will get started. So Jeff, thanks so much for inviting us to come on and kind of share what we feel like is a really powerful strategy for investors. And as we do this, we're going to build some context. I'll kind of then introduce us, kind of get into the investment optimizer a little more what it is. Blake's going to give us a breakdown on some of those details, and then hand it back to me, and we'll bring her home. But the first thing I want to talk about is who have we seen impact most from using the investment optimizer? It's high income earners who invest in alternative assets, who are wanting to start investing in alternative assets. So, well, what does that mean? Well, alternative just means non-traditional, and traditional we just think of as the stocks, bonds, mutual funds, 401ks, that kind of thing. And I would say most people that we work with are doing some form of investing in traditional assets, but they also, or for a lot of them, are putting a primary emphasis on investing in alternatives. And so, the kind of things that Valorous Capital are doing are the very things that, we see every day that our clients are using the investment optimizer to invest in. So it's a great kind of hand in glove type of relationship. So Jeff hit on this a little bit, but really quickly. So my partner Christian and I started Money Insights here a little over a decade ago, and combined between the two of us, Blake, Brennan, different members of the team, 50 years of experience working specifically in what we are doing right now, what we're going to talk about today. A lot of clients across all 50 states. We because of what we do, and because we do it primarily virtually, we're a kind of virtual office, so to speak. I feel like the social proof is really important. So we've gathered a lot of video testimonials. Jeff mentioned the Google reviews. We have a podcast where we teach the principles around what we're doing, not just with the life insurance, but with just the whole mindset philosophy around investing in alternative assets and why that's important, the kinds of things that we can benefit from. We'll get into that a little more here in just a minute. But what we see out there is that there are two wealth building playbooks, and the first one, the Middle America playbook, is all about tax deferral, accumulation based approach to retirement. It's very market centric. Like I said, the money going into 401ks and stock, bonds, mutual funds. And what I mean by the accumulation is it's just building up a lump sum to say, hey, how much do I need so that I can live the rest of my life and not run out of money, right? And so it's a very kind of scarcity mentality, because it's like, how much do I need? But then what we see is actually people get into that retirement phase, and then they're afraid to spend because they don't want to lose it. They don't want to run out before they die. And so it's just fundamentally a bad approach to building wealth, to retirement. So then what else do we see? Well, we see the wealthy family playbook, and that is based more in, if you look at the outer circle, more in alternative assets. And again, it's not that we're completely ignoring the traditional stuff, but we're looking beyond that. We're saying, okay, well, what other things out there can I use to build my wealth? Do it in a still a pretty secure way. Now that we're not taking risk, but everything comes with risk anyway, right? So let's look at it. Let's understand the risk. Let's invest. And then you see the inner circle here. We have these kind of core principles that we feel like are foundational to the investing side, and they're also the kinds of things that we can get in the alternative space that we can't necessarily get on the traditional side. So you look at something like leverage. There are some people who know how to leverage a stock portfolio, but most people don't and are not, especially if it's in a 401k. Whereas if I'm investing in real estate or my business or other things like that, then I'm using loans, I'm using leverage in a lot of different, a variety of ways to accelerate the investing that I'm doing, the growth that I'm able to create, velocity, cash flow. So this is probably the biggest one I want to hit on, because this is in contrast to what I talked about earlier with the accumulation method of planning for retirement. The cash flow method says I'm going to invest in places that creates cash flow. And when I have enough cash flow to replace my working income, now I know I'm ready. I can retire, and I can feel very comfortable in retirement because I'm not depleting an asset. I'm just living off of the proceeds of what's coming from that asset. There's still an underlying asset. It's still growing. And in the meantime, I'm just living off of the cash flows that come from it. And that is very different, fundamentally different from that accumulation method. And then, tax optimization, that's something that we get in the alternative space that you can't get. I mentioned earlier the Middle America playbook is all about tax deferral, right? I'm putting money into my 401k. Well, the problem is I'm not necessarily saving on taxes. I only am if I put money aside when I'm in a higher tax bracket than when I take the money out. But who knows, right? We're at a historically very low tax environment right now, with a lot of obligations that the government has in front of them. So chances are that taxes are going to go up. So for a lot of people who are right now setting aside money in their 401ks, there's a very good chance they'll actually pay more in taxes when they later take that money out versus what they're deferring in taxes today. So when we talk about tax optimization in this kind of wealthy family playbook, I'm taking advantage of the IRS code when I invest in real estate or my business or other things, and I'm creating real tax savings. It's not just deferring so I pay it later. I'm actually not ever going to have to pay that tax. So it's again just a different mindset. And then in the center here we have this opportunity fund. And what do I mean by that? This is the place that I'm building up capital that I'm going to use to go out and invest with. So when I invest in a piece of real estate, I can't just dollar cost average that, right? I have to build that money up, and often if it's a down payment because I'm buying my own property at $50,000 to $100,000 minimum to get started. Or if I'm investing in a private equity syndication type of deal, then again, often the minimums are 50, 100,000 plus. So I have to have somewhere where I'm putting that money to build it up. And this is actually where we're going to primarily focus in our conversation today with this conversation around the investment optimizer, because there are just some inherent challenges that come with this idea of using investing in alternative assets, and specifically that opportunity fund. And what are those? Well, number one, what kind of return am I getting on my money when I'm between deals? When I'm building up inside of that opportunity fund, how is it growing? I also need it to be liquid, so I can jump on opportunities as soon as they come. Wouldn't it be nice if that opportunity fund also came with some tax advantages? And then safety, knowing that the money is going to be there, right? When I'm ready for it, I can jump on it, I can use it. So the idea what we saw real life working with people that invest in alternative assets is that we needed a better opportunity fund, because the places that people were and use before they meet us, before they learn what the investment optimizer does, is primarily through bank accounts, right? In your savings account, that's where I store my money. That's where I keep it until I've built up enough to go and invest. Maybe a money market. Once I have that money built up, I take it out, I invest it to create some sort of cash flow coming back. And then I capture that money back in the opportunity fund, the money market or the savings account. And then I go back out and invest it again, right, in something else. And we do that because of the safety and the liquidity that those accounts bring. But the problem is that it's not really doing much for me. And if I try to force the issue and I say, well, let's put it somewhere where still I can access it when I need it, but it's going to grow for me. Well, so maybe I put it in a brokerage account. Problem there is, who knows, right? What the market's doing at the very time when I'm ready to access the money. If it's 2008 and I've been waiting, right? Because 2006, 2007, prices were going crazy. I'm thinking I'm going to wait this out and before I start buying properties. Well, 2008 comes and all of a sudden the value of properties has dropped. It's a great opportunity to now go buy. Oh, but too bad if my money was in the brokerage account, I just lost 40% of it, right? So we need an account that does better, right? Still gives us the safety and liquidity, but also is working for us. So what we've done is we've created a strategy that allows us to do the same investing that we're doing, but increase the returns without additional risk and in this opportunity fund. And that's what we call the investment optimizer. So now I'll kind of switch over and let Blake walk us through what the investment optimizer is, how it works, and really how it accomplishes the things that I've been kind of teasing so far.
It's great, Rod. Thank you. And now I get to jump into some of the kind of exciting details in terms of how the strategy actually works and some of the numbers behind it. So, as Rod mentioned, Jeff, you did a good job setting it up. The investment optimizer strategy is really utilizing these high cash value life insurance policies as your opportunity fund, leveraging those to do the exact same investing that you were going to do otherwise. So it's not at all like we're changing what you're investing in, but do all of that without taking any additional risk and increasing your returns. You're going to maximize retirement cash flow. That can all come out of this strategy tax-free as well. Increase your tax savings. I'll jump into the details of how that works. And at the end of the day, as Jeff said, we are, no matter what, going to build generational wealth when we implement this strategy into what we're doing on the investing side. So when we talk about life insurance, right? What we're talking about here with high cash value whole life insurance, this is probably not what you've heard of from your friend or from, the local agent in town where he says, hey, you need a certain amount of life insurance. This is really the exact opposite. And what I mean by that is the life insurance contract that we're using as our opportunity fund has to be designed, it has to be structured correctly. And what I mean by that is when we're designing the policy, we want to opt for the dollars that you're putting into the strategy. We want to optimize that to build up what's called cash value. So we want the highest amount of cash value. That's really your asset in the policy. And to do so, we want to minimize the cost of insurance as much as we can. So it's probably, think about the typical insurance that you buy. You want maximum coverage for minimum cost. This is really the exact opposite, where we're trying to maximize the cash value benefit and then kind of reverse engineering the policy to say, hey, what's the minimum amount of cost that we can get onto it? So the structure of the policy is extremely important in what we're talking about here. So then when we design these policies in this way that I'm talking about, again, maximizing what's called the cash value, minimizing the death benefit or the costs that are associated with getting this going, we really build this perfect opportunity fund for any type of alternative, any type of cash flowing investment. So what do I mean by that? Well, first off, again, designed correctly, you can expect to see a 5+% rate of return. That's after costs, after fees. We're getting that 5+% return on our capital on a compounding basis. Not only that, we have complete liquidity over the cash value that's in the policy. So as soon as you fund the policy, within 30 days, you have access to the cash value in there. It doesn't need to be in there for a long time. So this is, a place where you can store your liquidity. And then additionally, as Rod had mentioned about potentially using a brokerage account if you're looking to get more returns, this is the exact opposite. So there's guarantees in this contract that we know contractually the cash value has to go up every single year. So you cannot ever experience a loss in this. So there's liquidity, there's safety. And then additionally, that 5+% return I'm talking about, that's actually a tax-free growth. So to be clear, this account works very similar to maybe like a Roth IRA, if you're familiar with that, where we're funding the policies with after-tax dollars. But then after that, all the growth, that 5% plus we're getting each year, that's growing on a tax-free basis. When we access the money, that comes out tax-free. And then this fifth benefit is a death benefit, which eventually would pass out tax-free. Now, we mentioned death benefit. Obviously, as I said, we're trying to design this to maximize cash and minimize the death benefit as much as we can. However, when you start flowing your capital that's going to be going into investments anyways through this strategy, it's very likely you're going to create 7, if not 8 figures of additional benefits, something that you really don't have to pay for in any other way. That's eventually going to get passed onto your family, and again, allowing you to do the exact same investing. And then really the key kicker here, which I'll dive into next of exactly how this works, is this idea that you can have your money working for you in 2 places. So to be very clear, we don't work with people who are just trying to find a place to put their money to get 5%, right? We can get a lot greater returns in a Valoris Capital deal, right? But this strategy allows you to get that return in addition to what you're getting in the investments. So we'll kind of break down exactly how that works here. So we just came up with kind of a basic example looking at, so we ran analysis on a debt fund, okay? So we said, okay, person A is just going to invest in this fund. This fund was going to pay a very simple 12% return over the course of 15 years. So if you did kind of the traditional style, you built up money in a bank account, you went and invested in this debt fund, you got the 12%. Over the course of 15 years, you would have turned that $100,000 into $280,000 or a net gain of $180,000. Great, pretty simple investment. Now, if we invested in the exact same debt fund, but first flowed the $100,000 through the investment optimizer policy, captured all the benefits I was talking about, and then utilized what's called the policy loan feature, which I'll go into on the next slide of exactly how that works, and invest in the exact same debt fund, earning 12%, net after everything, you would have taken that 12% deal and turned it into a just over 15% deal because we had our money working for you in 2 places. So this is just kind of gives you a snapshot of exactly what we're talking about in terms of investing in the exact same assets, but doing so in a more profitable way. Okay, so how exactly are we doing this? How can we have our money working for us in 2 places? So we have an example up here. We got this guy, we call him Dr. Z. He's got the cool hair. So what he's doing, Dr. Z, he's an investor, okay? So he's taking his dollars and he's first capitalizing his opportunity fund. By the opportunity fund, we're talking about a high cash value, whole life insurance policy. So he's taking his dollars, he's putting it into this opportunity fund, and that money's growing at 5%, as I mentioned. So in that, there's a guaranteed return, depending on the companies that we're using, somewhere between 2 to 3.75% guaranteed. Plus, we're utilizing what are called mutual life insurance companies who, with a mutual life insurance company structure, they pay dividends to their policyholders. So with the guaranteed interest plus the dividend, that's how we're generating that 5% return. Now, when Dr. Z is ready to go invest, as opposed to taking his money out of his opportunity fund, like you would a bank account or frankly, most accounts that you're storing up your capital, as opposed to doing that, by having money in this opportunity fund, he gets access to this much bigger bucket of money. Okay. And that bucket of money represents the general account of the insurance company where he has the policy. Okay. So as opposed to taking the money out, what he can do is request a loan. So for example, let's say he said, hey, please send me $100,000. And that money that hits his bank account, that is actually directly coming from the insurance company. So he takes that $100,000 or whatever the number is and goes and uses it to invest in whatever he wants. There's no restrictions. There's no underwriting for this loan. Simply by having the cash value, you get access to this loan. So he takes the money, the $100,000, he goes, puts it into whatever he wants to invest in. Let's just say it's a cash flow real estate investment. And as that real estate property is creating cash flow, he's just utilizing the cash flow from that deal to repay the loan that he took from the insurance company. So that is kind of how the flow works, where really the key piece here I should mention is that as you operate this strategy, as you take a policy loan, because we never remove the money from our opportunity fund, the entire amount continued to compound like we never touched the money, because you have all of the capital still in that opportunity fund. So there's kind of two interest rates going on here. We're growing our money on one side. When we're taking that policy loan to go out and invest, we're also paying the insurance company an interest rate to borrow their money. So I kind of want to jump into, on this next slide here, exactly how the numbers play out. So we mentioned, your cash value in your policy is going to grow by roughly 5%. When we take a loan from the insurance company, typically rates are right about 5%. There's a little bit of fluctuation there. But what I want to hit on here is, if you think, okay, I'm earning 5%, I'm paying 5%, essentially that's a wash, right? How am I getting out ahead? And really the key component here is this idea of earning compound versus paying simple interest. So to put some numbers to this, let's say you took that $100,000 loan and we were being charged 5% by the insurance company, and you decided to pay that loan back over 20 years, for example. Well, over the course of 20 years, paying that $100,000 back, you would have paid $60,000 of interest to the insurance company, to utilize their money. Now, on the flip side, our money in the policy, because we never removed it, was still earning compounding interest. So that $100,000 continued to compound over that 20 years. And at the end of the day, that 100,000 would have grown by 165,000. Meanwhile, on the interest side, we were paying $60,000 of interest. So to be very clear, that's using the same interest rate. So we're earning 5 and paying 5. It's the type of interest that we're earning on the compound side versus paying on the simple side, which is where we're able to create this arbitrage. So at the end of the day, you would have profited, an additional $105,000 earning the compound versus paying the simple, in addition to whatever we earned in the real estate investment that we would have done. That's why we call it the investment optimizer. This $105,000 arbitrage is earned in addition to whatever you're also investing in at the exact same time. So now I want to kind of just talk about the flow. If you've heard of this strategy, it's becoming more popular, but if you haven't heard of this strategy before, it can sound maybe a little bit complex. And at the end of the day, not a lot is changing. So again, a typical investor is building up their funds into a bank account, right? And then they're out on the market, they're looking for a place to invest. Okay, I found a syndication or a piece of real estate that I want to deploy my capital into. Well, typically, again, you're taking that money out of your bank account, you're sending it over to the investment. That investment then creates cash flow. And as that cash flow comes back off the deal, we're just using that to build up the bank account again and go out and repeat this process over and over. And really that bank account is the opportunity fund. With the investment optimizer, really the same thing is happening. We're really just adding one step, where as opposed to having your money in a bank account, we're capitalizing our opportunity fund, this high cash value life insurance policy. When you're ready to invest, you're taking a loan against that policy, going out and investing in the exact same deal. And as that cash flow comes back off the deal, we're just funneling it back to repay the loan. And strategically, what's happening there is just building up our opportunity fund to, again, repeat this process over and over. So the flow of the money is exactly the same. We're just changing really where we're storing our cash in between deals. So with that being said, Rod, I'll turn it back over to you to kind of maybe put some more numbers to this, more of a real life example, and take it from there.
Perfect. Yeah. Thank you so much. Okay. Yeah. So what I want to do now is say, all right, well, let's kind of follow the life cycle of what this looks like as somebody is doing this. They're putting money in the policy. They're then using it, flowing different investments through it. And what I want to do is kind of, we're going to approach this again from the standpoint of a person A, person B. Person A on the left-hand side is investing in syndication and or other multifamily real estate, and they're flowing that money through the investment optimizer. Person B on the right-hand side is doing the exact same investing, same investments, but they're just flowing their money just through a regular savings account like we typically see when we're first meeting up with people. And and then follow this through. So over the next 20 years, well, what happens, right? So initially, well, sorry, let me tell you what's happening in terms of what they're setting aside. So in both cases, we're saying they're setting aside 100,000 a year for 5 years to kind of capitalize their funding strategy. And then they're taking that money, even in year one, taking what's available, going and putting that into a syndication that starts to create cash flow coming back to them. They capture that cash flow in the system, and that's part of what they're using later to go out and invest in later things. So, and then in year five, they take what they have available, use that as a down payment to go buy a piece of property. And again, cash flowing property, as that cash flows, they capture that back and flow that back through, build that back up, go invest in something again, year 10, year 15, year 20. Okay. So in some ways, I admittedly we're simplifying this process. People aren't necessarily waiting 5 years between deals or things like that. But we didn't want to make it overly complex, just so we could see kind of side by side, here's what's happening. Well, if we start from the beginning, the first 100,000 goes in, and you'll notice that on the investment optimizer side, we don't have quite 100,000 that we're putting in that first deal. And that's because even though, like Blake mentioned, we're minimizing the cost, keeping them as low as possible, there is some cost associated with setting this up. So I think of it as like startup costs, right? I'm getting the policy going. The costs are a little more front end loaded, is the way that the kind of costs work in these policies. So in this case, I have of the 100,000, I have 74,000 that I'm using to go out and put that in first investment, right? But of course, the right hand side, the full 100,000, because I don't have those same costs, right? So you might be thinking, well, G-Rod, so far it's looking like the right hand side's better, but that's why I use the kind of comparison with startup costs, because if I'm starting a business or I'm buying a piece of property, I have costs that I'm putting in up front with the hopes and trust that I'm going to be able to turn that into something better later on down the road. And as you can see, as time goes on and we're then capturing those benefits that Blake talked about, the growth, the predictable growth that's happening, the arbitrage, the simple versus compound, et cetera, over time, we're getting to a place where we're able to buy bigger deals. We have more money. We're building more wealth because of the investment optimizer and what those benefits give us. So that when you fast forward to the end of 20 years and you compare person A versus person B, we actually have $2.1 million more wealth that we were able to build with person A because of the investment optimizer. And that's really the only difference. Again, same investment, same rates of return, same cash flow based on those rates of return. But with the investment optimizer, an additional $2.1 million of value. And so this is what we mean when we talk about create additional value, do the exact same investing. We're talking about a place where you can literally build more wealth. In both cases, we started with 500,000 and turned it into a lot more, but with 2.1 additional because we used the investment optimizer. So going back to this kind of wealthy family playbook visual here, when we look at the opportunity fund and we say, okay, what's the best way that I can take advantage of these investment principles that we have on that inner circle to invest in these types of assets that I'm showing on the outer circle? And we just feel like hands down, the investment optimizer is the best way to flow in and out of those deals for all the benefits we talked about. Because what the investment optimizer allows me to do is create higher overall investment returns. It's critical, Blake mentioned this, but it's critical to remember we're not suggesting to make the policy your investments. Still go and invest in the same things you were going to anyway, but flowing the money through the investment optimizer increases your investment returns, improves your cash flow, optimizes retirement income, creates real tax savings. And we didn't spend any time on this, but there's some risk mitigation and asset protection elements to it based on state law. Most states give you a really good benefit in terms of any money I have in my cash value life insurance policy is safe from creditors or from lawsuits. And in the end, what's this all doing for us? It's creating an accelerated wealth creation scenario. So then the question is, okay, that's all great. So I understand the investment optimizer. So you guys at Money Insights, what can you do for me? And we basically do three things. Number one, we teach you how to implement the investment optimizer. So we obviously talked about that today. We have a lot of material. I mentioned our podcast. We have additional videos, different webinars that we host, different things that we do to help people see how to implement the strategy, because it's not just a policy, right? What you have in your policy is absolutely critical, but kind of talked us through that. But then it's the strategy. How am I using it to improve my investing? And so we help our clients do that. Second, we help to maximize tax-free income. So we think of it in terms of my investment phase as phase one of the policy. But what happens after that? So I've built up all this money inside of the policy, and then what, right? Does that just mean my kids get more inheritance? Well, no. When I'm in this kind of retirement phase, it's a great way to create tax-free income. I can flow the money back out of that, and because of all the tax benefits, I can take out tax-free income from it. And ultimately, the third thing we do is we can help you accelerate your path to financial freedom. So if this is intriguing, but you're saying, hey, I like this, I want to learn more, go ahead and download our ebook. We have the QR code there. You can download an ebook about the Investment Optimizer, Investment Optimization 101. Learn more about how to use high cash value life insurance to boost your investment returns. And if from what you've seen already, you're like, hey, I think I would be interested in having a conversation, learning more, getting some feedback on how this could help me in my situation, then we have the QR code on the right-hand side. Go ahead and follow that, schedule a meeting. As you can hopefully tell, we're very much education oriented. So in a meeting like that, we're learning a little more about you and your situation, kind of what type of investing you do, answering any questions that you have. And then really, the goal is to get enough information so we can send you additional information, learn more, see how it can fit kind of in your world. And so those are a couple things that you can do to learn more. If there are questions, please go ahead and pop them into the Q&A. I'm more than happy to answer any questions you have. Jeff, anything on your side any questions you had?
No, I think I haven't seen any questions yet, but I think it's amazing. So I appreciate you guys going through really what the investment optimizer is and how that works. Just a little kind of world life example, right? So I use my life insurance policy. So again, the reason why I wanted to introduce Rod and Blake over to everyone in our network, right, is that this is exactly a strategy that I've been using for the past couple years. And I wanted to really have a chance for people to kind of sit down and really kind of understand it, see it visually, and then have a chance to kind of talk through it with Blake and Rod if you wanted to kind of see what it would look like for something for your side of the house, right? So for real world example, I did this with a my life insurance policy. I front loaded it, right? I front loaded the high value cash life insurance policy, and then I immediately took that money out for an investment where I was paying. I think my loan was right about 5.1, so you're very close, Blake. It's right around the 5-ish. So my loan was 5.1. So I need to find something to arbitrage to invest in that was a little bit more, right? That was going to give me more of a return. So I invested into our private credit fund that brings a 14% return on my investment, right? So right there, that private credit fund is paying for the loan itself, right? So it's already paying for my life insurance policy loan, which is already compounding inside that loan policy, already earning another 5% on that side. And I'm arbitraging, making another 9% on my return of my investment there. So double dipping, so to speak, right, is the way I look at it, right? Where if I can make this, I use the same dollar I initially put it into the cash value life insurance first to make an investment in another vehicle. That to me makes complete sense, right? Arbitrage, right, is the word that I love to use. So again, putting it into where do you put your money first, right? You put your money into your growth fund, right? Your opportunity fund first, right? Before you go ahead and put it into your investment fund. All right, we do have a couple Q&A that did pop in. EX, I don't know. Eric, there you go. Eric is his first name. He says, is the max loan amount capped by the cash value of the policy?
Yeah, I can take that one. So the answer is yes. And typically, the insurance companies will allow us to borrow up to 95% of the cash value at any time. So if you think about borrowing against another asset like a portfolio, let's call it a stock portfolio, you might be able to get, depending on how it's invested, 50, 60, 70 percent. But Eric, the answer is yes. You're borrowing up to, again, around 95% of your cash value is what's liquid at any point to loan against to then go use those funds for investments.
Yeah, and he asked a follow-up question. He said, "And are the payments only interest or interest and principal?"
Okay, great question. And what is really nice about this, so when you take a policy loan, there is no required repayment back to the insurance company, which is very unique. So if I go for a loan at the bank, right, obviously I have to be underwritten for that loan. I have to have someone approve it. And then when I get those funds, they're going to require a monthly repayment, very likely back. If I don't make those, they're taking the cash back. The policy loans are a little different, or a lot different, I should say. And the reason why is they still have your cash value there sitting as collateral. So when we request that loan, let's say you canceled the policy, 6 months later, they have your cash as collateral. If you were to pass away, same thing. They would just take the loan amount off your death benefit and pay out your heirs whatever's left over. So the insurance company's whole, but what that allows us as investors to do is completely control that repayment schedule. So yes, you're going to have a loan, there'll be interest. Our recommendation as we're working with people is typically at a minimum, you'd like to pay that loan interest each year, because that's what keeps that loan simple and not compounding on you. But you have complete control and autonomy to repay that loan however you want. You could even not pay principal at all and only pay interest over the years. And then if you get a lump sum, you could pay it back. If you never pay it back, eventually your death benefit will pay that back for you. And then again, your beneficiaries get whatever's left over at the end of the day.
Yeah, there's another good example people say where if you're buying a car, right? Instead of buying the car with a loan, you buy the car with a cash value loan, and then you treat yourself like the bank. So you start paying yourself back with interest and principal. So if your loan payment is $1,000 a month, right? Then you pay $1,000 a month towards your policy, and that goes towards principal, and the interest is usually collected at the end of the year anyway. So you put everything into a separate bank account, and that is where you withdraw your monthly payments back to your principal. So your principal is getting lowered, and then at the end of the year, your policy is due for your next payment. Your interest is due, so you pay the interest on that as well too. So it's kind of like thinking about it as like you're treating yourself, or you're paying your own principal and interest back at the schedule you want it to be at, right? So we have another question from Stuart. So Stuart says, "What age bracket is this best suited for? I am 67 and the cost of insurance is higher than, say, for my 30-year-old daughter."
Yeah, I can take that one. And the answer is that we have a lot of clients who are starting these policies in their 60s, 50s, 60s. And so it's true to say that the insurance is higher for someone in that age bracket. But we're using the same formula either way. We're going to reduce the cost and maximize the growth of the cash value. And but still, comparing the 67-year-old against the 30-year-old, you would still see cash value grow a little bit better in the 30-year-old's situation versus the 67. But you might be surprised when you're comparing those against each other how similar they actually are. So let's take Stuart's example. It's very common for people to, in a situation like that, if you looked at it and you said, "I'd rather have the policy on my daughter," we can actually do that. So you would be the owner. You'd be flowing the money in the policy. You'd have access to it. You'd do all the things we've talked about today. But your daughter is the insured on the policy. And so ultimately, when you pass away, then you would just be basically passing the policy intact. The cash value would pass along to her. And then she could potentially use it in a similar way. And then death benefit ultimately pays out when she passes away. But again, there are pros and cons to doing that. But that's a conversation that we would be happy to have and basically show, hey, here's what it looks like with the 67-year-old. Here's what it looks like with the 30-year-old. If when you pass, death benefit pays out, then that actually creates more money sooner than if you're just looking at the growth of the cash value on the 30-year-old and where it gets to at that point if you passed it like whatever age 90 or something. So again, we can look at it together and kind of make that comparison, and then ultimately you get to decide which one you feel better about doing on that.
Awesome. And then Stuart asks, "Isn't this risky if your investment loses money?" I guess I can answer a portion of that, and then if you guys want to take over after I answer. But
Sure.
Stuart, I would say the life insurance policy is not risky, right? That is a steady growth. Those businesses have been around. The mutual life insurance firms have been around for 160 plus years. They've never missed a return on their guarantee because you'll have what's called a guarantee and then a dividend. So the guarantee is your guarantee return, and then they'll have a dividend, which is that's what fluctuates based on the returns from the life insurance policy. And Blake can get in, and Rod can get more details there. But just like any investment, so if you were to invest in take your cash, right, or a self-directed IRA, and you invest it in a piece of real estate, whether it be like a syndicate, we'll go through a syndication, um, anytime you invest into something other than, a savings account, you're going to have a potential to lose your money, right? There is an at risk that at anything you do, right? So it's just a matter of understanding that risk, and then having an ability to uh, underwrite it to a position where you're comfortable with what those risk factors are, right? So, Blake, do you want to jump
Yeah,
in there?
let me add, because Stuart, what he might be asking, and feel free to chime in if I'm not hitting on it correctly. Let's say I've got this policy, I take whatever $100,000 loan, I go invest in a piece of real estate which loses value. Am I out at that point? I would actually make the argument that it's less risky to invest through the policy. The reason I say that is that 100,000 that you've loaned against, that is still in the policy continuing to grow. So you've lost, yes, the value of whatever you invested in, but you're still capturing some benefit. Now we have that loan out there as well, but as mentioned, you can service that loan even by just paying the loan interest each year, or if you get a windfall from something, another investment, or whatever the case may be in business, you can repay it that way. So it is extremely flexible. And even if that investment goes belly up, of course, that's like a not ideal situation. We're trying to avoid that as much as possible. You still have some growth in the policy as well. Rod, any other thoughts on that one?
Yeah, and so you talked about the different scenarios of what options you have. Just pay towards the interest, pay it off with other investments. Again, you have the cash value sitting there. You could even take from the cash value and pay off the loan. If ultimately you're like, hey, I don't want to see that loan on my books anymore. Your asset's sitting right there. You can just use it to pay off the loan if that's where you are. So that's why I agree with what Blake's saying. It's not any more risky. If anything, it might be less risky just because the other stuff you get.
Yeah, Stuart, hopefully that answered your question. Excellent. And yeah, I don't see any other questions, but are there any like typical questions that you guys hear from individuals that maybe you want to cover real quick?
Yeah, one of the ones I'll hit on here is, when people think about whole life insurance, they're wondering, hey, am I committing to funding this policy for my entire life? And again, a typical whole life insurance structure, that might be the case. With what we're doing with these highly overfunded policies, that's absolutely not the case at all. So let's say you set up a policy where you said, hey, I want the ability to put in up to 100K a year. It could be whatever number you want to put my cash into that and then turn around and loan against it to go invest. We build in a lot of flexibility into that each year. We call this concept the funding range, meaning each year you can choose to put in up to 100,000, or it might be a minimum of 20 or 25,000, meaning each year you're deciding how much you want to put into that policy anywhere within that range. And then on top of that, you're also able to stop funding the policy if you want. As soon as 3 or 4 years. Oftentimes we'll start with, hey, here's what it looks like if you fund for 7 years and never again after that. And you just kind of see how the cash value compounds over time. So that would be the one question, when we're working with people, they're like, hey, what exactly am I committing to? It's actually a much shorter time frame. Oftentimes you want to keep putting in money because I'm putting in $1 and my cash value is growing by $2 down the road, right? I want to keep funneling that and then use that to go invest. But there's a lot of flexibility built in with how much you're putting in and how long you're contributing into the policy over time as well.
Yeah. And usually if you're using like a life insurance rider, right, like the term rider, like that might fall off after like 5 or 7 or 10 years, right? Where
Yeah.
then your minimum payment will always be much lower than what your potential minimum payment could have been, right?
I would say, yeah, that's accurate. There's a lot of different ways we can design the policies. You know, on an individual basis, depending on what you're wanting to do, we can optimize the policy for basically any situation. But what you're saying is accurate there, Jeff.
Nice. One more question from Stuart said, is this a IUL policy or Index Universal Life?
Yeah, I can answer that. Uh, Typically, we're using whole life. Having said that, it can index universal life or IUL can be used. And maybe just to give some people context, if you're not familiar with the difference between the two, in both cases, they fall under the category of what's called permanent life insurance. So it's not term. Term is for more of a set period of time, 10 years, 20 years, and then it falls off. Permanent life insurance, the intention is that I have this life insurance that lasts the rest of my life, no matter how long I live. And so both whole life and IUL fit in that category. They're also both building cash value. The biggest difference comes in I have the cash value sitting in my policy. How is it growing? So we've talked about with the whole life policy, it grows based on guaranteed interest rate and the dividend. On the IUL, it grows based on what's happening in stock market index. So, for example, the S&P 500 is a very common index to use. And so what it does is I have my money in my account. It never goes anywhere, right? It stays in the account. It's not invested in the stock market or anything else. But what's happening is they're deciding how much interest to credit my account each year based on what the stock market is, what the S&P did over the previous year. So if it grew, then I get an interest that matches how much it grew up to a cap, and caps are right now about 10% on the S&P 500. So if the index went up by 5%, I get a 5% credit. If it goes up by 20%, I'm capped at the 10. So I would earn a 10% interest credit in that year. In years where the S&P loses value, I don't participate in those losses. I just don't earn any interest in that year. So when you compare the two against each other, in either case, I have kind of that downside protection. I'm not worried about losing or participating in market losses. With the whole life, it's just very consistent and predictable what I'm earning each year. That's why we tend to use whole life with this. And that's why we lead out with whole life. Because in other words, I'm taking a loan against that cash value. And when I go out and invest, I'm taking enough risk where I've invested it. I don't want to also have to be worried about kind of looking over my shoulder what's happening in the stock market. Therefore, how's my policy doing? Because with the whole life, it just plods along and does what it does. Another difference is, Blake mentioned I can get up to 95% loan against my cash value. That's true with whole life. With IUL, it's depending on the company, 85 to 90%, so a little bit less access to cash. But at the end of the day, if someone looks at it, understands the difference, and says, "Oh, actually, I do want IUL," then great. With the principles can work. Again, we want to keep a closer eye on it, especially if I'm taking maximum loans. Then we want to make sure that we're keeping an eye on what's happening with the underlying account so it doesn't kind of implode on us. But it certainly can be used.
Beautiful. Awesome. Well, we appreciate everyone jumping on. If there are any other last questions or anything else, Blake, you and Rob want to mention before we wrap it up? No,
Nothing from my end.
Just, yeah, super grateful to be here.
Perfect.
And hopefully this has been useful for people and kind of given an idea for something that maybe you hadn't heard of before.
Excellent. Well, we really appreciate your guys' time here, and thank you so much, everybody, for joining. And we'll also send this recording out, and it'll be located on our website as well too. So, appreciate everybody's time, and thank you so much, and have yourself a great day.